Well, a warm welcome to everyone, and thank you for joining us today. My name is John Carty from Solace Financial, which is a locally owned and locally staffed firm in Brisbane. Today we have Warryn Robertson from Lazard Asset Management. Warryn is a portfolio manager and analyst from global listed infrastructure and the global equity franchise teams. He's also a research analyst on the Australian equity team. He's been working in the investment field since 1992. Prior to joining Lazard in April 2001, Warryn was an Associate Director of Capital Partners and worked at PricewaterhouseCoopers in corporate finance. Warryn holds an MBA from the Melbourne Business School, a Bachelor of Commerce from the University of Canberra. Before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statement regarding financial product information for further information regarding the things we discussed today. Details of this general advice warning can also be found on the moneysmart.gov.au website. Thanks for joining me today, Warryn. As a fund manager specialising in global equities, can you talk us through Lazard's history and investment philosophy?
Sure. Lazard's been around 175 years now. The three brothers started out essentially funding the gold rush in California. And it wasn't that they invested in the guys that were digging the gold mines. It was the ones that were selling the picks and the shovels, and famously Levi Strauss of jeans fame. And I think that sort of history actually resonates through the Global Equity Franchise Fund in terms of its investment philosophy. It's about the businesses that are predictable, more forecastable, not the ones that are going to be the great stories but necessarily, but the ones that are going to be around for a long time.
Okay. So what's the investment process you use at Lazard?
So we have a 4-stage investment process, as most people do, but essentially it's about 2 steps. It's about identifying from the range of MSCI World opportunities, those stocks that we define as an economic franchise. So they're predictable, forecastable generators of earnings and cash flows. Because at its heart, what you do as an investor every day is to sort of forecast earnings and put a multiple on it to come up with a value, or to forecast cash flows, put a discount rate on it to come up with a value. So if you can find a group of businesses that are more predictable because they're market leaders and or monopolistic in their nature, they're going to have more predictable earnings and cash flows. And we think that gives you a head start in terms of being able to get that valuation problem right.
Okay. Well, how do you assess the investment risk when you make the investment decision?
Great question. Essentially, we start up front. So I think there's 2 ways of managing risk in our strategy. The first is to only look at those companies that we define as an economic franchise. So they're monopolistic, they have or market-leading positions. So they're companies that essentially aren't going to be knocked around with the whims and changes of investment tastes or consumer preferences. They have embedded businesses that have been around in many cases for over 100 years. And so from that perspective, you manage the risk up front in terms of that earnings predictability and that cash flow forecastability. And then essentially what you're then doing is coupling that in universe of what are quite predictable businesses with a very deep and very strong valuation focus. So we're looking to buy businesses that we think are trading at a discount to intrinsic value. And that's the way you manage both that risk. Predictable businesses trading at a discount to intrinsic value.
Okay. So what are the opportunities and risks that you see in the marketplace at the moment?
The universe is quite sort of split between haves and have-nots, and I would think there's more have-nots than haves. So what do I mean by that is the world is expensive from an equity markets perspective. So you need to be selective about the stocks that you're looking at in terms of that matching that valuation conundrum and that valuation problem. Clearly, the opportunities we're seeing are actually in sectors that are outside the mainstream press. So everyone's getting very excited about AI. They're getting excited about information technology. They're getting very excited about the United States. Well, our strategy is underweight the US quite considerably. We're seeing opportunities in the UK and Europe. We are seeing opportunities outside of information technology. So utilities, very mainstay, monopolistic infrastructure consumer staples, healthcare are some of the sectors that we're finding great opportunities in. But it's not a top-down perspective. We're finding, great businesses that are in market-leading positions and/or monopolies that we think are trading at a discount to intrinsic value. They just happen to be, at the moment, outside the US and certainly away from information technology.
Okay. So what would you say is Lazard's greatest strength as a fund manager?
I think it's starting from the perspective of what is the investment problem you're trying to solve and being fixated on that investment problem. For us, it's around looking at a select universe of investment opportunities, and we start with 4,000 stocks around the globe and end up with only 250 that we concern ourselves with value. And then once you have that, you're saying, actually, I'm only going to concern myself with today 25, 26 stocks that we think actually demonstrate the sort of opportunities that will generate our objective, which is our objective is clear. It's to generate a return of 10% per annum over rolling 5-year periods or greater. And so to do that, we need to be concentrated today. So I think the strength is to focus in on what is your investment objective and to stick with that objective, not to be swayed by the news of the day or the story that everyone wants to buy into. It's about sticking to the discipline of what are the types of companies I want to own, and then what is the right price I want to own them at.
Okay. Can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the performance around?
Yeah, we've had that. We've been very fortunate. If you look at the calendar year performance of the strategy, 7 of the last 10 years, we've outperformed MSCI World as a benchmark. We've outperformed the value index in 8 of the last 10 years. So, but there have been periods when it's not been as smooth. We've had some, particularly around the early periods of the COVID pandemic. When you're buying businesses that have market-leading positions, monopolies that enable people essentially to go about their daily lives. So, buying lotto tickets, driving toll roads, utilities, if you like. All of a sudden, we didn't go about our normal daily lives. We owned IGT, which owns the concession of the lottery for Italy, which is the biggest lotto in the world, but no one was actually going to the tobacconist or newsagent to buy lotto tickets. We own toll roads in France and in North America, but no one was traveling to work. So the businesses had this absolute glitch, a 1-in-100-year event, and that created, quite a dislocation for clients at the time who were worried that, was this the start of something that changed the long-term investment thesis? What we did was we went back and said, has something fundamentally changed here that we think is going to affect this business for the next 10 to 20 years? Now, clearly, there's going to be a dislocation at the start. COVID, we're going to have some form of recovery, but the world is going to move through this event. Easier to see in hindsight than what it was at the time, but we still believed in the investment thesis of the business that we own. So we actually didn't turn the portfolio over all that much. We had stocks that fell, we bought more of them. We had stocks that we thought needed to potentially raise more capital to right-size the balance sheet. And we had conversations with the companies around that, and we were confident that they could work their way through that difficult period. And what we had was then, a couple of years later, those stocks that cost us that money in early 2000 were the ones that made us a lot of money in 2022. So it proved to us our investment philosophy is right. This concept of an economic franchise, businesses that have long-run predictability of earnings is the right way to go. But it also proved to us as long as we're patient and wait for the market to recognize the valuation to come through, you will make money. It is about just being patient at that time. We were patient with the companies for them to come right. Our investors need to be patient with us to make sure that we would solve that problem and to make back that ground. And we did do it. It took 12 months, but we got back to where we were, and we did incredibly well for the 12, 18 months beyond that.
Okay. So with the investments that you have at the moment, what are the latest additions to the fund?
Yeah, so I mean, as you can imagine, with 260 stocks that we're constantly looking at the valuations of, and with predictable businesses, their valuation actually doesn't move that much. The market price moves around, but the valuation doesn't. So that gives you chances to buy and sell new names. So, I mean, recently in the portfolio, we had the opportunity to buy into, probably 12 odd months ago now, a company called Henkel, which is a consumer staples business, predominantly with detergents and the like, but its core real economic franchise business is its dominant market share in adhesives and glues, industrial glues and the like. That business had some issues in terms of customer end demand in China, where it has quite a large market share. But what we saw was that was a short-term hiccup. The business came out the other day and said we're going to reiterate 15 to 25% earnings growth, call it 20%. And happily we exited that business and did very, very well. Likewise, you're seeing these short-term noises create the opportunities that I spoke about. Rentokil, which is the largest pest control business in the world, actually acquired the number 2 player, Termimax, to create this behemoth. I mean, basically 2/3 to 70% of all industrial pest control is controlled by Rentokil now globally. But that business is going to have a 3-year digestion period. And what you're going to see is the market sort of got a little carried away with itself. They spoke about $250 million of synergies, and the brokers, in infinite wisdom, because they've never managed a business, thought 80 million, 80 million, 80 million over the next 3 years. Now, anyone who's bought a business or been around markets long enough realizes that the first 12 months you're trying to figure out what's really going on under the hood, and then you can get those synergies in the second and third year. So the first quarter result came out disappointed, share price fell 30-odd%. We thought the fundamental picture hadn't changed, so we bought in at those lows, and essentially we've been rewarded really well, because only a quarter later they said actually the business is better than we thought. Our long run synergies we believe now will be 250 million. We believe our margin will be at least 200 basis points higher, and the share price recovered virtually all of that loss. And so we've made incredibly good money off it. So it still staggers me every day that you have these businesses that are really quite predictable. They have market-leading positions, or they're natural monopolies and they're regulated with either utilities or toll roads and the like, and really predictable. But the market will just fixate itself on the short term, not the long-term view, and that's what creates the great buying and selling opportunities that we will take advantage of when the opportunities arise.
Oh, wow. Okay. So, Warryn, you've got many companies in your portfolio. How do you stay up to date with changes in the financial markets?
Yeah, I mean, we try and keep away from the noise. Warren Buffett famously says that Omaha, Nebraska is about the right distance from Wall Street, and maybe Sydney on the other side of the world is probably equally the right distance away. So, when you're focused on long-term valuation, long-term earnings power, you're really not worried too much about the day-to-day. But what the day-to-day gives you is the opportunity to trade around that long-run valuation. So, your valuation won't move 5-10% on a given day, but the share price certainly can, and that's what gives you the buying and selling opportunities. So, although we have FactSet, Bloomberg and the like, I might glance at that once or twice a day. I'm spending my time really looking at the portfolio, the projected returns from the stocks in it, names that may have moved around, like I mentioned Rentokil before, like I mentioned Henkel. Those opportunities will present themselves on a daily basis for us to take what really are predictable, great businesses and to be able to make good returns out of them. But, the one truism we always stick to is that as good as the 250 businesses are in our investable universe, the key is that the greatest business in the world will not make you a good investment if you don't pay the right price for it. So being totally focused on what is the right intrinsic value for each one of the names that we have in the 250 stock universe, and having them ranked from the most attractive to the least gives you this great tool to allocate capital. And sort of that's how we keep up to date with financial markets. It's what the market noise creates in terms of buying and selling opportunities that we will take advantage of. And some days we won't. Some days we'll sit around and actually the best thing to do is not to trade because, the market opportunities haven't presented themselves. But when they do, we mercilessly take advantage of them.
Okay, so last question, Warryn. What makes a good portfolio manager?
Well, this prefaces the response that I think I'm a good portfolio manager. I think as a team, we work really well. I think the key to managing portfolios is to surround yourself with like-minded individuals who have a clear focus on what is the long-run objective that you're trying to achieve. And for us, it's that 10% per annum over rolling 5-year periods. It's focusing on a certain group of companies that you can remain, trying to have a view on 4,000 businesses is really difficult. Trying to have a view on a really difficult business to understand is really hard. I mean, if you think about investment problems, You think of Visa, which is like the toll road for the payment system of the globe, right? They clip the ticket every single time you spend the money on a Visa transaction. That's a great business, and it's 70% margins, close to 100% return on assets, really predictable growing earnings over a long period of time. Compare and contrast it to something like Tesla, and you go, okay, 5 to 10 years, I don't know what it's going to be doing. I don't think Elon Musk knows what he's going to be doing in the next 5 minutes. So that's a really difficult problem to solve. They've got a checkered operating history. So, focusing on what you think you're good at, which is simple investment problems done really well, I think is the key to it, and keeping away from the noise. Letting the noise come to you and to take advantage of it, I think is the absolute key. So having a value rank, a key view on value that the team has come up with individually for each one of those, say 260 stocks that we look at, knowing what we think intrinsic value is, waiting for the market to give you that opportunity, to be patient. I think patience is the absolute key, because we know these businesses have the embedded economic franchises, have the economic moats, have those leading market positions or monopolistic infrastructure assets that will produce consistent, predictable earnings over a long period of time. There'll be something that's created the buying opportunity today. It's just waiting for the market to recognize that value in the future, and to be patient to wait for that to happen, I think, is what makes a good investor.
Okay. Warryn, I appreciate you making the time to talk to me today.
Thanks very much for having me. Appreciate being here.